Despite today's pullback, though, there has been a massive run-up since the election. But are retail investors getting bullish and buying stocks at the wrong time? Bob Pisani takes a look.
If you're a little skeptical about the markets hitting historic highs twice last week, you should be. The market's on a little bit of thin ice right now. Now, here's why. First, investor sentiment has gone from skeptical to extremely bullish. That's not a good sign, particularly when you see it happening among retail investors. At the end of last week, a survey of retail investors spiked to almost 50% bullish from 23% bullish just the week before the election. It was the highest reading in nearly 2 years. Now, big spikes in retail investor sentiment have traditionally been associated with at least a short-term top in the market. Second, going long stocks and short bonds, it's a lot less attractive now than it was a month ago. The trade's been made. The small cap Russell 2000 is up 13% in 3 weeks. And bond prices, the 10-year yield, down about 3%. The retail investor seems to be excited right at the market top. Finally, the rally is pricing in a near perfect environment, but there's a lot of things that could go wrong. So a strong dollar could be a big problem for multinationals who export, as well as for emerging markets like China. Second, any move to aggressively translate Trump's trade war rhetoric into reality will be a big problem. Third, lengthy delays are likely in enacting any stimulus or infrastructure plan, tax cuts, and reductions in regulations. All three of these, for the most part, late 2017 and 2018 events. Finally, the biggest problem could happen if the Fed starts sounding like it may raise rates more aggressively than expected. The markets definitely have not priced that one in. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.